Hello. Welcome back to One Piece Trade Tech. At One Piece Trade Tech, we focus on extracting information that can guide investment decisions from financial transaction data not typically available to retail investors. It has been over a week since last time I uploaded a video, and the original plan was a daily update, and however, my lovely cat was so thoughtful and wished to give me a break that he pushed my laptop over the desk and I broke it. But anyway, uh, before we move on, please subscribe to this channel and we'll try to provide you a market perspective quite different from most venues, as we do not use publicly available information such as price or news in most of our analysis. However, for this video series, I will use a public information in our analysis, as it is more of a macro market development analysis and is less time sensitive. In this series, we will focus on COT report analysis, which I wish to do for quite a while. There are YouTube channels talking about COT reporting. However, I think there are much more detailed and nuanced information that we could extract from the report besides net position data alone. I'll try to bring it up and share my own takes and understanding from the report contents here. The COT report is published by US CFTC, Commodity Future Trade Commission, I think. It aggregates large traders' position status on the futures market by the end of every Tuesday and publish it by every end of Friday. And thus inherently the COT report contains information lag behind the market for a few days. But however, it is still extremely useful in providing guidance on the future market development. I will not go over any other basic information on the COT or emphasize how valuable it is to the investors here anymore. Anyone interested in finding out more about the COT report, please refer to the CFTC official site. And there are also a few books focused on COT reporting and how to use it, implement it in your investment operations. One popular book was written by Larry Williams. I can't remember the name exactly. You can look it up. I think it's something like the Bible in COT report, something like that. And now I'll go straight to the report data analysis. And today we'll look at the gold, which is the superstar of 2025. And first of all, as a disclaimer, all content from now on are my personal speculation from the data released by CFTC. The audience should not take these as financial advice. This is just me sharing my my understanding from this report for educational or just basic sharing my perspective. There are three types of COT reports: the legacies, the financial, and the disaggregate report. The legacy is a traditional reporting format that and include all future contracts. And the financial future and the disaggregate reports are more detailed breakdown from the legacy report, where trader categories are more clearly defined. All physical commodities will appear in the disaggregate report, such as gold, aluminum, platinum, something, and all the financial related future contracts such as e-minis or uh, forex are included in the financial future reports. And first, we look at the legacy report in gold. In overview section here, we see the open interest. The open interest here in the recent months has drastically declined. Open interest is not necessarily directly related to the change in price, but it shows how hot the underlying asset is in the market. And here we see that in the recent market, interest in gold is declined compared to last year. Either the market participants actively close out the contract, or they just let the contract expire without rolling it over. Either way, the result that we see is that the overall open interest declined. And but there are still more than 500,000 active contract out there. It's just not as many as back in 2025. And the components in the components chart, I create this is to show all the long or short contract, and how many of these contracts were held by commercial or non-commercial traders. And a little tip is that non-commercial traders are typically benefit from trading the trend, or from trading price change itself. They are the speculators in the market, such as hedge fund or leverage fund CTAs. And the commercial traders in the legacy report are quite broad. The definition is quite broad. They may include the producers, miners of the physical asset. They could include treasuries, corporate treasuries. They could include banks, commercial banks or central banks. They could include a typical sell side exchange, the sell side firms that act as a counterparty of the speculators, etc. And so the focus, the interest of the commercial traders in the legacy reports are not universal. So some may not focus on profiting from trading activity. So so in this legacy report, right now I do not see anything alerting in recent development, as we see that the yellow line is a non-commercial. The non-commercial are dominant in opening long contract in gold, as these people, as these categories, they benefit from following the trend. And as this is still, I think we still categorize the current market as a bull market. So they are traditionally buying gold. And for the short contract, on the short side, the commercials, they remain dominant, as we mentioned, that they are typically the counterparty of the speculators, which are typically the non-commercials, and that they are, and some of them are what we call they are physical producers, or the industries that actually buy and manufacture or sell gold for physical use, and they have to open sell contract on the market to hedge their business risk or lock in their price. So they are the major player on the short end. But we don't see anything alerting just from this chart alone. And now let's look at the non-commercial category, as these groups they mostly follow the market development. Let's see. Okay, so but first of all, most retail investor and hedge fund, they fall into they should their behavior are quite close to the non-commercials, as we all benefit from. We all look for profit from trading itself. So let's look at these, and here we focus on look at the positions. The position held by the non-commercials. As we see, the yellow line is the short contract. First of all, in the non-commercial categories, there is a concept called spreading. here we in our chart we exclude the spreading. Spreading is just the number of contract that canceled by again the detailed information I will not go over, but spreading it's just the spreading count does not affect the net exposure of non-commercial trader category. So we exclude these numbers. Uh, uh, Here, I think the main takeaway from this chart is that we see as we enter 2026, the long interest or the long exposure by the non-commercial traders have been decreasing as we enter 2026, while the short interest in gold remain stable or inactive. The long interest, especially for the past 2 months, have been really stable, either because of the current geopolitical conflict going on in the market, or because the historical high price in gold. There's no there is really no clear or correct answer on why the speculators have been staying out of the not out have not been actively trading for the past 2 months. But what we can only see what we see, which is there is no there is no active no active trading uh, in by the non-commercial from the long end for the past few months, or another I think another way to put it is that the market participant who are who hold long bias in gold have been uh, trying to stay on the side uh, as the markets develop for the past 2 months. And I think we all know the reason. It's just and we're sure that as there is a clear as the as how to say as the market develop into a clear or uh, uh, vision, I would say these market participants will definitely come back. But for now, I think no one is holding a no one have a better idea what will happen. Uh, but and for the commercial side, uh, also for the commercial side, we see that there's a decrease in the commercial short because, and this makes sense as the commercials are, as the non-commercials, they open less long contract as the counterparty of the non-commercials who are typically reactive. Uh, they will hold less short contract, which is nothing alerting. For more detailed information, for more breakdown information, we have to go to the disaggregate reports. And so here for the disaggregate report, the category is more detailed. We have producer, which are they are generally engaged in the physical production, processing, packing, or handling of the physical assets, like jewelries or miners, etc. And the managed money, these are mostly the non-commercials in the legacy reports. They are the CTAs, they or hedge fund. The swap dealers, they are I think they are the participants that engage in using the future market to hedge their risk or in their transactions. So basically, these are the sell side. These are the dealers that keep the market active. And the other reportable groups, they are institutions such as the corporate treasuries, the central banks, commercial banks, credit unions that use future markets for their own business interest. So these are the four major categories in the disaggregated reports. And we look at their components in the long and short contract. I think uh, here that you see in the long contract side, the dominant participant are the money other managed money, the CTAs, aka the speculators, and the other other reportable groups, which, as we mentioned, the central banks falls into this category. And as we know, for the past few years, the central banks are the major participant in buying gold. So it makes sense that in the futures that they are also the dominant buyers. And the yellow line, the managed money, that they benefit from the bull market. So these two groups are the major buyers, which is right. And on the short end, we see that the dealer, the swaps, they are the market makers. So if people are buying, that they are on the sell side, and the producers, they are, I mean, it's futures markets, and we all know that the the modern futures markets, um, these physical producers, they are playing a smaller roles in futures market as a whole, but they're, I mean, a future market is necessary in their operations, but they are small players, which is fine. I mean, they are here whether on regardless of the market. And I think what's worth noticing is that for the past few months, the managed money, the let's use a number. The most recent data release data is April the 7th, where 15% of the short contract were held by the speculators, by the managed money traders, while a month ago, only a month ago, only 12.6%, only 12%, or were held by this group. So what happens? Let's look more into the details. The managed money. Here we see, look at their positions. Uh, in the bull market, we see that there is really nothing going on the short side, but the uh, on the long side, the managed money are actively buying or selling on the long contract in gold. But as we see, this is the same observation we see from the legacy report, that as we enter 2026, these the buyers in the gold market, they have been reducing their long exposure in the gold market, and for the other reportable as well, we see that maybe it's the central banks or the treasuries. Either way, we don't have any other further breakdown, but we see as a group, the managed money and the other reportables, which have been the major buyers in 2025, have been reducing their long interest in gold, which is the same observation we see from legacy report again. And for the swaps, okay, swaps are the major sellers on the gold futures, and as we said, they are reactive. They are the counterparty of the buyers. So as the buyers open less long contract, they open less short contract, which is fine, nothing alerting. But I think from the both disaggregate and legacy report, the takeaway is quite aligned, which is uh, which is that the speculator in recent months they reduced their exposure in the long side, and this also aligns with the price development in gold, as we see that gold has not been able to make any further upside breakout for how many for approximately 2 months, which is exact time when the buyers have remain inactive in the market. And I think there is no direct explanation, but I think but I think the reason the geopolitical conflict in the world could explain this phenomenon, as most market participants are probably waiting for further development in the world, and without clear vision, I would not expect any big players putting themselves uh, on either side, and and thus I would suggest that the upside, at least the upside potential of gold in near future is quite limited, and I think that is but this is on the macro on the macro market level. On the micro level, we have our institutional fund flow indicator that provide guidance on daily trading activities, which is in a different video series. But this is the end of our COT gold analysis. And again, please subscribe to our channel and share your comment with us. And also welcome to visit our website, which is onepiecetradetech.com for more powerful tools. And right now, in the below description, you will see that right now we are uh, offering a one-time deal, as we are in the process of migrating our servers. And you can use the promotion code provided, and you will have full access to our service until June the 1st, 2026. And you will not have to put in your payment information, and your membership will automatically expire on the June the 1st. So you do not have to worry about canceling the membership to avoid any charges. And if you think the tools add value to your trading operations, you can continue to use it, and we will be working to upgrade our technology and services to help you in your trading journey. And also subscribe to this channel, and we will constantly upload videos and tutorials on how to maximize the utility on our tools to aid you in your trading. Until then, bye.